Hello, and welcome back to the demo portion of our lecture series. So, just a reminder, we're talking about Chapter 14. Chapter 14 is all about corporations and dividends, retained earnings, and reporting income. So, what I'd like you to do is grab your books, and I want you to open up to exercise 14-3. And I have the ebook here, and it looks like it's on page 634. If you have a physical book, it might be a little different. But we're going to work on exercise 14-3. So if you don't have your book in front of you, pause the video, go get it, bring it back, or pull up the ebook, and that way we can go over the problem together. Okay, so hopefully you grabbed your book. Exercise 14-3 says that on January 1st, 2017, Frontier Corporation had $1 million of common stock outstanding that was issued at par. It also had retained earnings of $750,000. The company issued 40,000 shares of common stock at par value on July 1st, and they earned net income of $400,000 for the year. Okay, they tell us that they want us to journalize on the declaration date a 15% stock dividend on December 10th, 2017 for the following independent assumptions. So each of these assumptions give us a different par value as well as a different market price. If you see in part A, it says value is $10, or par value is $10, market value is 18. In part B, it says par value is 5 and the market price is 20. Okay? So the first thing that we need to do is we need to figure out A, as of December 10th, 2017, what are the total shares outstanding? Okay, that's number one. So I'm going to come off to the side, and if you notice here, I created a journal here because obviously we have to do journal entries. So the first thing they tell us is that they have $1 million of common stock. Notice what this is. This isn't they're not telling us the number of shares. They're telling us, here's the dollar amount. Okay? That's as of the beginning of the year, right? On January 1. Say 1/1. Okay? Then they tell us on July 1st, they issued 40,000 shares of stock. So on 7/1, they issued 40,000 shares. Here, these are shares of stock. Okay? The problem here is we need to figure out on December 10th, should be 12/10, how many shares of stock are we paying out as a dividend? Super easy for us to do, okay? We know that in part A, the par value is $10. Okay? So to figure out the number of shares that are outstanding, all I need to do is calculate. I need to take into account the 40,000 shares that were distributed on July 1st. And then I need to do a calculation to figure out how many shares is that $1 million of common stock outstanding. So in order for me to do that, I'm going to take the dollar amount of my common stock account. It's worth $1 million, okay? I'm going to divide that by my $10 par value. Oh, sorry. And that means that there's 100,000 shares, okay? That's 100,000 shares on January 1st. But don't forget, on July 1st, I issued 40,000 more shares. So that means the total shares that I have outstanding as of December 10th, 2017 are 140,000 or 140,000 shares. Okay? That's number one. Number two, I need to figure out what is the value of this dividend, right? Or this stock dividend. Well, that's easy. I know that I have a total outstanding of 140,000 shares. This stock dividend they declared was a stock dividend of 15%. So if I multiply shares outstanding currently times this stock dividend that I'm going to pay out, 15% of the 140,000, I get 21,000 shares. Beautiful. Okay. Second thing we need to remember, we are issuing 15% stock dividends. Is this a small stock dividend or a large stock dividend? And I hope that you either went through your notes or remembered that 25% is that threshold. Anything 25% below is considered a small stock dividend. Anything over that 25% of common shares outstanding is a large stock dividend. What's the difference between the two? Well, if you remember, if we are doing a small stock dividend, we must use the market price. If we're doing a large stock dividend, excuse me, we just use the par value. Okay? So, halfway there. I know that the current market value is $18. Right? Sorry, stock dividend. I know the current market value is $18. Okay? If I multiply the number of shares that we're paying out as a stock dividend times the market value, that's the amount of my journal entry. Okay? So I have the journal entry right here. Now, here's the key. I got to do the journal entry, right? So, if you haven't, pause the video, go back to your notes and find what is the journal entry that we do. Okay, so hopefully you've checked your notes. You know that we need to debit stock dividend account for how much? Well, we already figured that out. That's going to be the 21,000 shares times the market value, because it is a small dividend. We're going to use the market value of $18. And our debit is the $378,000. We already figured that out down here. Okay? Step 2 says, the second part of the journal entry says we got to identify the credits. Now, I hope that you went back, looked through your notes, and you saw that, we have to credit common stock dividends distributable. That's kind of our liability. We got to pay these out. And then chances are, since we're using the market value, guess what? There's going to be a credit to paid in capital in excess of par common stock. Okay? So, first thing I'm going to do is I'm going to debit my liability, I'm going to credit my liability here of common stock dividend distributable for how much? Well, that's easy. 21,000, that's the number of shares, times the market value, right? Well, if we do the market value, that puts us at the $378,000. It's not exactly right. Remember, we use the market value to determine the stock dividend. That means that we need to credit the common stock dividend distributable for the par amount. In this case, our par amount is $10. And if my math's right, that should be $210,000 credit to common stock dividend. We have a difference, right? Debits and credits don't equal, so we need another credit. Well, we already know that since we're booking it at the market value, $18, the common stock dividend distributable was recorded at the par value. The difference between the two has to be the paid in capital in excess of par common. And that's going to be the difference between the two, right? $168,000. So now our debits and credits equal. We're good to go, okay? Now, let's look at Part B. Part B says what? Well, it says that our par value and market value have in fact changed, right? In Part B, the market value is $20 and the par value is $5. Super easy to do. We're going to do the same exact thing that we have done before, right? The only catch is we got to recalculate everything, okay? So we know we have $1 million, right? We know we issued 40,000 shares on July 1st, but this time our par value is now $5, okay? So we take 1 million divided by 5, that gives us $200,000 shares, or 200,000 shares as of January 1st. To that, we add our 40,000 shares that were issued on July 1st. We end up with 240,000 shares outstanding, right? We're still paying, excuse me, we're still paying 15% dividend, stock dividend. So we see that the stock dividend number of shares is 36,000 shares. But in Part B, the market value is not $18 anymore. We changed it to what? 20. So we have all our numbers. Now all we need to do is do the journal entry, right? Back up for 1 second. Okay, so this one's going to be for Part B. We're going to do the same exact journal entry. We're going to debit stock dividend. For how much? Well, it's going to be the 36,000 shares times the market value of $20. We end up with $720,000. Okay, that's our debit. I have to credit common stock, right? Or specifically, common stock dividend distributable. This is my liability. I owe somebody stock, okay? Specifically, I owe current shareholders more stock. So we need to figure out what is the amount that we're going to book to the stock, common stock dividends distributable account, and how much are we going to book to the paid in capital in excess of par. Common account, okay? Well, this is pretty easy, really, right? Think about it. How common stock dividend distributable. We're issuing 36,000 shares at what price? Well, since we're dealing with the common stock dividend distributable, we're distributing them at a value of par, which in this case is $5. And if my math is right, 36,000 times 5 gives us $180,000. That is the credit entry for our dividend distributable account, okay? Now, we have our paid in capital in excess of par, common account. we need to hit that. Well, what's the dollar amount? Well, think about it. The market value is 20. The par value is 5. The difference between those two is that paid in capital in excess of par. So we're going to take the $36,000 times the $15. And bear with me here. Okay. So to figure that out, we just multiply. We end up with $540,000. Okay. So we went through how to calculate a stock dividend, noting the accounts that we're going to debit, noting what we're going to credit, and recognizing that if they give us dollar amounts, we can calculate the number of shares. Okay. The next example that I'd like to look at with you guys is exercise 14-4. Okay. It's excuse me, it's on the same page as the previous one that we did. Bear with me here, I clicked off it on my ebook. Okay, so what we're going to do now is we're going to do another example of dealing with stock splits. Okay, so on exercise 14-4, we have a company, and as of October 31st, they give us all the information for the stockholders' equity account, right? Heinz Company consists of common stock, $500,000, retained earnings, $900,000. Heinz is considering the following two courses of action. A, we declare a 5% stock dividend on the 50,000 $10 par value shares outstanding, or affecting a 2-for-1 stock split, right? This stock split will reduce the par value to $5 per share. Current market price is $14 per share. We need to do a table, and we need to show the difference between each action, okay? So I'm going to create a new tab here. Bear with me here. Okay. And let me make this a little bigger. Okay. So we're going to do an example, or we're going to go back to the slides, or I want you to think back to the slides. And remember, we had an example of before action, after stock dividend, after stock split, and we had that table. We're going to do the same exact thing. Okay. So the first thing that I want to do here, we'll go for. Okay. So the first thing we're going to do is we need a column that says, hey, this is what our numbers were before any action was taken. We need a column that says, hey, this is after a stock dividend. And here is what the numbers will look like, excuse me, after a stock, after stock split. Okay. So what we need to do is list out our stockholders' equity, right? So first we're going to list, or we're going to, sorry, we're going to put this in financial statement form, so to speak, right? So we want to have stockholders' equity. Okay. And then we have the next thing that we need to write is our common stock, or I'm sorry, paid in capital. And if you think back to chapter 13, paid in capital is made up of two things: common stock, and it's also made up of paid in capital in excess of par, common, and then we have our total paid in capital. Okay. Now don't forget, underneath the stockholders' equity section, we also have our retained earnings, which we need to enter. And I want this to line up with that paid in capital header. Okay. And then after that, we have our total stockholders equity. Okay. All right. So, excuse me. Before any action was taken, they tell us that the common stock has a value of $500,000. Okay. We have no paid in capital in excess of par. Our total paid in capital is going to be our $50,000 or $500,000. They tell us that the retained earnings at this point in time is $900,000. So that must mean that our total stockholders equity section has to be valued at $1,400,000. Okay. How many shares outstanding do we have before the action? Well, we can do one of two things. We know what the par value is of the stock. They told us it's $10. Or we can just go back to the problem, read it, and recognize that we have 50,000 $10 par value shares outstanding. So the number of shares are 50,000. The next thing that we need to include is the excuse me, the par value per share. Okay? And the problem tells us that is $10. And there we go. Okay. So now we need to think about the stock split, right? What's going to happen? Well, we need to do obviously some calculations here. And the calculations are really easy, right? We're declaring, we want to figure out what our stockholders equity section is going to look like after a stock dividend, okay? Well, let's think about this. We want to pay a 5% stock dividend, correct? Because that's what they told us in the problem, okay? So to figure that out, how many shares? Well, that's easy, right? We're going to take, and I'm just going to, actually, let me do it this way. So I'm going to come down here and just show my calculation, okay? We have 50,000 shares times 5%. And if my math's right, that should be 25,000. No. My math is not right. So if we take 50,000 shares times 0.05, that gives us 2,500 shares. Okay? But our common stock has a par value, right? What is that par value? Well, the problem told us it's $10. per share. So now, if I multiply my 2,500 shares that's going to be paid out as a dividend times the par value of $10, that equals 25,000. So that means after the stock dividend, my common stock account is going to be valued at $525,000. Okay. Now, the next thing I need to look at is my in excess of par, right? How do I figure that out? Well, that's super, super easy, right? And come here, put 2 stars. So here's our calculation, right? We know that we are going to issue 2,500 shares, right? We know that the market price is $14 per share, right? We had a par value of $10. The market value is 14, so there's a difference of 4, right? So just for the sake of argument, I'm going to take my $14, which is my market value, minus my $10 par value. That gives me $4, right? So if I multiply the 2,500 shares times the $4, that's 10 grand. Okay, so that now means that my paid-in capital in excess of par common account has to be $10,000. Okay, so now I can figure out what is the total paid-in capital account worth. Well, that's easy, right? 525,000 plus 10,000 gives me $535,000. Okay. Now, we need to recognize that between these two, before action and after stock action, right? We can see that our capital or paid-in capital accounts together, both the common stock and the in excess of par, went up by $35,000. Where do dividends come from? Well, their value has to come from that retained earnings, because we need to have retained earnings in order to pay any type of dividend. So what I'm going to do is figure out what is my new retained earnings after the stock dividend. Well, that's easy. I'm going to take my retained earnings before any action, and then I'm going to subtract out the $35,000. We end up with retained earnings of $865,000. Beautiful. Okay. Now, I'm now going to calculate what is the new total stockholders' equity after the stock dividend. Well, that's easy. I'm just going to add them all up. Add up my total paid-in capital, add up my retained earnings, I get $1.4 million. It's still the same thing, right? Now, I need to figure out what are my shares outstanding. Well, that's easy. I had 50,000 before I declared a stock dividend. 5% of the 50,000 is 2,500. If I add those together, I get 52,500 shares of stock now outstanding. Okay. What is the par value? Well, it's going to remain unchanged. It's still $10 per share. Okay. So that's how we do our stock dividend, right? And this is what the retained earnings look like after that stock dividend. Now let's forget about after stock dividend and let's just focus on after a stock split, right? What does it look like after a stock split? Well, let's think about this. And let's think back to the lecture portion. The only thing that really changes is the number of shares outstanding and the par value. Par value decreases by whatever ratio the stock split is. And the number of shares outstanding actually increase based on that split ratio. Okay? So after the stock split, right, what happened? Well, we had $500,000 worth of stock, common stock. That did not change, right? So I still have $500,000. Any paid in capital? Well, no, I just doubled whatever people had outstanding, right? If they had 50,000 shares outstanding, now there's 100,000 shares outstanding. I didn't have to hit my paid in capital in excess of par account, so that does not change at all. What does change is going to be down here, the shares outstanding and the par value, okay? So what's my retained earnings? Well, my retained earnings are $9,000, or $900,000, sorry. Jesus. There we go. Okay. So what is my total retained earnings after the stock split? Well, I just gave people just have less, or they have more stock now, right? They have more shares. They have actually double the shares that they had before. Didn't impact my retained earnings. My retained earnings is going to remain the same, meaning before and after the stock split. It's still going to be 1.4 million. Now, how many shares outstanding do I have? Well, think about it. It was a 2-for-1 split. So we had 50,000 outstanding. Excuse me. Those people now get double of what they had. So if there's 50,000 outstanding, that must mean I have 100,000 shares outstanding. The par value is going to be cut in half, right? Why half? Well, because it's a 2-for-1 stock split. So instead of the par value being 10, it's now going to be 5. Okay? So we indicated, for this one, we indicated the balances after the stock dividend, and we also determined the account balances after the stock split, right? After the stock split, none of the accounts changed other than what we have showing as shares outstanding and the par value, okay? So is there a difference here from the company standpoint? No, not really, right? Our total stockholders' equity really did not change. It's still $1.4 million regardless of what we do, right? We have more shares outstanding, obviously with the stock split and with the stock dividend. The stock split decreased our par value, where the par value per share did not or was not affected for the stock dividend. Okay, so there it is right there. So that's our examples of how to book stock dividends as well as to book stock splits. Okay, tune in for our next video where we go back to our lecture portion and we talk about learning objective 3. So tune back in for that one.